Well, inflation in China has hit a two-year low. Good news for consumers, but not necessarily for the economy as a whole.
Official data shows the Consumer Price Index, a major indicator of inflation, rose 0.1% in April compared with the same period last year, a smaller rise than expected. Some economists see it as a further sign that domestic demand remains lacklustre and that more stimulus may be needed to boost a post-COVID recovery. Core inflation, which excludes food and energy, remains steady at 0.7% year-on-year.
Let's talk to Marc Ostwald, Chief Economist and Global Strategist at ADM Investor Services International. Marc, welcome back. Good to see you. Are you surprised by these figures?
No, not at all. I mean, in terms of the consumer prices, a lot of that was actually to do with base effects due to on food prices, particularly vegetable prices, are down very sharply. Pork price inflation has come down very sharply. But if one looks at, there is a little bit of an uptick in terms of services, but outside of that, demand is weak, and it was also very evident in the producer price data, which came in down 0.5% on the month, minus 3.6 year on year. That was worse than expected. And if we add in then the monthly monetary aggregates or credit aggregates, which were very, very weak, it really does show that particularly consumers in the lending data, basically paid down debt, both for mortgages and for short-term loans for larger ticket price purchases. It really shows that there is something needed to boost consumer confidence. And it probably will take a little bit of time.
What does all this tell us about the trajectory of the country's post-pandemic recovery?
Well, for the time being, it's going to remain quite weak. I think it will start to accelerate as we go through the second quarter, and it will be more evident, particularly in the May data. You should see quite a decent boost to services spending from the long May bank holiday. And it probably also says that the PBOC will likely institute some form of small interest rate cut, largely to deter consumers from putting money on deposit and paying down debt and getting them out there to spend. There's an element of trickle-down economics there, which around the world generally tends not to work too well. The key, I think, actually is going to be how weak export demand becomes, because that could be quite a significant drag, having been a prop, particularly during the zero COVID period.
So which are the sectors driving China's economy?
Well, certainly infrastructure spending, local government spending is being boosted. And the infrastructure spending, particularly in terms of the energy transition, it's really very, very much needed. So, it's justified, but there is obviously a problem that local government does actually have quite a lot of debt. That's doing well. Services spending is picking up. I mean, one has to be a little bit careful here because there are trends evident elsewhere on reopening, where you saw a fairly sharp fall in spending on goods, which I think accounts for a lot of the consumer price weakness, while services picked up. But it takes time for that services to pick up. I think it's above all going to be evident in air travel and domestic travel. That you should see quite a marked pickup as we go through the summer.
Marc, good to see you. Thanks for coming back on the show. Marc Ostwald, Chief Economist and Global Strategist at ADM Investor Services International.